In this video, we're looking at the different elements of return with a total return strategy, assuming you have a diversified portfolio of assets such as cash and bonds, and then likely a bunch of diversified stocks, and also potentially globally diversified real estate. If you kind of look at each source of return, cash and bonds, their primary source of return typically comes from interest payments. So when you pay them $100 to purchase the bond, you agree upfront that whatever, let's say interest rates are at 4% at the time, they're going to pay you $4 per year every single year until the bond is what's called matured. That's just the end of the life of the bond, at which point in time you will get your full $100 back. Imperfect analogy, but think of it like you're renting a place and you have to pay a security deposit of $100, and then they're going to pay you $4 of rent each year for as long as the lease goes for. And then at the end, you're going to give them their security deposit of $100 back. That's exactly the same way a bond works. Now, in the meantime, between when the bond originally comes out and when the maturity of the bond, this $100 price will change because even though interest rates were at, say, 4% right when the bond came out, interest rates are always changing. So the relative attractiveness of this 4% bond is always changing depending on whether interest rates have gone up or they've gone down. That's more for a video another day. But let's say that, interest rates are around 4%, and so we end up getting 4% rate of return in any given year from our cash and bond portfolio. Then we've also got kind of our what I call growth portfolio, which is stocks and real estate, and those elements of return are more dividends and capital appreciation. Now, if you look historically, dividends have made up, about 2% per year, and then capital appreciation has been the biggest element of return. Depends on which time period you look at, but if you look at the longest time period available that we have data, it's been about 8% from capital appreciation. Now, again, these are not guaranteed in any given year. All of these are changing in any given year. This capital appreciation number could be down 20% in one year. It could be up 35% in another year. This is assuming a long enough time horizon to get the long-term expected rate of return from these types of investments that we have. Again, dividends are always changing. They've kind of come down over the years as companies have pivoted more towards stock buybacks and reinvesting in the growth of the company to increase earnings and ultimately the valuation of the company. But a lot of companies are still paying a dividend, so a modest rate is about 2%. So if we were to look at, what if we had, say, 70% within stocks and real estate, and then our remaining 30% within cash and bonds, total return. Again, this wouldn't happen every single year, but if we get a 4% interest rate times 30%, that's a 1.2% weighted average return. And then 70% is kicking off a 2% dividend, that's 1.4%. And then 70% is providing 80%, so that's a 5.6% return. When you look at all of that factored in from this diversified portfolio, that's an 8.2% per year annual return, or that's the total return from all sources of this hypothetical portfolio.